Hello, everybody, and welcome to my channel. And this is the show where I, Michael Duke, analyze stocks that are interesting. So if you think that's interesting, then please consider liking this video and subscribing to the channel. Just a few moments ago, I did a video about DoorDash, ticker DASH. And I've kind of been looking at that one in parallel with Maple Bear Inc., ticker CART. Maple Bear is the holding company of Instacart. So obviously, Instacart versus DoorDash, there's some overlap there in terms of their businesses, albeit with a slightly different focus. So, as usual, I'm going to give a brief overview of the business. I'm going to take a look at their financials, at the stock price. I'm going to take a look at the valuation, the growth, and I'm going to do some technical analysis. And last but not least, I'm going to give it a grade. So, without further ado, Maple Bear Inc. Maple Bear Inc. doing business as Instacart. Pretty interesting. Why not just change it to Instacart Inc.? What's going on there? Let's make it easy. I was going to say, that makes it kind of weird. Anyways, Maple Bear Inc. engages in the provision of online grocery shopping services to households in North America. Service can be provided through the company's mobile application or website. The company also provides advertising services and software as a service solutions. Incorporated in 2012, headquartered in San Francisco, California. So also headquartered in San Francisco, along with DoorDash. Instacart is not as large as DoorDash is, both in terms of scale and market capitalization. You see here, Instacart is roughly $13 billion market cap. Now, notably, it has a strong buy in the Seeking Alpha Quant. For those that aren't aware, the Quant rating has fairly good track record. DoorDash did not have a strong buy rating, by the way. But we see here over the last several years, we've gone from $1.5 billion of revenue to just over $3 billion. So we've more than doubled revenue over that 5-year time frame, and further strong growth projected. The company is profitable. In fact, it enjoys much better margins than DoorDash does. Again, I'm not crapping on DoorDash, but I think it's just a logical contrast to point that out, because again, DoorDash has been a very strong performer over the last years, crushed the market, and Instacart has also performed strongly, but not nearly as much. So I think there's might be an interesting divergence there. But we see here gross profit 75% is incredibly strong, and a double-digit return on equity. Much better than DoorDash, which I think I need to highlight this just to show you. And DoorDash up 121% on the year. It's growing faster. In the time that revenue doubled for Instacart, revenue has almost quadrupled for DoorDash. But we see, this is what I was highlighting, profitability. 50% are higher gross profit margin, but low single digit margins elsewhere, and only a 4% return on equity, whereas Instacart has a much better looking profitability profile. We see the stock here has really outperformed the S&P 500 over every one of these timeframes over the last year. This company is interesting because I feel like it's kind of flown under the radar. It's only been public since the third quarter of 2023, but pretty strong performer in that time frame. So what is Instacart exactly? Well, of course, Instacart is the platform that allows you to, a shopper will be, they'll take on a job. I've never shopped for Instacart before. I have delivered for DoorDash, so I am more familiar with how DoorDash works on the shopper side. And DoorDash has this service as well, where they'll actually go. You take the order, you go in, you pick the items, you get you check out, you go and deliver. But that's essentially what Instacart is. You are dispatched to a location to fulfill an order, and then you deliver the order to a person. So much like I discussed with DoorDash, the company is asset light, highly scalable. They own the platform that is, benefits from very, very strong network effects in a highly, highly scalable manner. Allows them to serve a wide range of end consumers and end markets, both now and in the future, potentially. And you see here, DoorDash has been a much stronger performer here. But nonetheless, very asset light model. We're relying on third party contractors to fulfill the shopping uh, portion, and then fulfilling the labor aspect of it. Whereas at the corporate level, we've got a very asset light platform. Another thing that's been interesting is that, as far as I'm aware, well, we see Instacart is also active in acquisitions. For example, this is May 1st, about 9 weeks ago. Instacart announced its acquisitions of WinShop, a provider of e-commerce solutions for grocers and retailers. WinShop will initially operate as a wholly owned subsidiary. Over time, Instacart expects to expand more of its enterprise technology solutions to WinShop's partners. I do feel like this stock flies under the radar. We see here 7,500 followers versus 30,000 followers for DoorDash. Well, let's take a look at their numbers at a high level before we get granular. Again, this company's only been public for really less than 10 quarters here. So let's just take a look at their quarterlies. We see here revenues in September 2022, the quarter ending there, 668 million. We're at 900 million now. So not even 50% in that time. That's very, very strong, double digit compound growth. Here, 485 over 668. Let me just do some math on my calculator. 485 by 668. So that's 72.6% gross profit in that quarter. And that's before it was public, by the way. 671. Now we're doing most recent quarter divided by 897. 74.8. So gross profits have expanded, margins have expanded in that time, indicating a strong moat. I think it goes without saying that the company has a moat, given that it's the owner of a platform that, again, benefits from network effects. The gross profit profile, given that the gross profits are so strong and that they're expanding even from a very high foundation, is indicative of a strong moat. We see here operating income has been fairly flat over that time. So they continue to increase SG&A. We see here in this quarter, this is when they went public here. It looks like they had quite a bit of chargebacks there that they put into the IPO. You see here, earnings from continuing operations. There isn't really a clear, strong upward trajectory, but again, this graph is a little flawed given that one huge negative quarter there. But we see from 36 million to 106 million. Again, that's two and a half times ish. Pretty good. Net income tracks the same. Earnings per share, they were profitable at the time that they went public. So that's, again, different than DoorDash, and looks really good. And they've actually decreased their share count since going public in aggregate. Please watch my DoorDash video I talk about the how the share count has gone up for DoorDash, whereas the share count here, they've been a little bit more aggressive in buying back shares in excess of any stock-based comp that they've issued, given that the share count is going down. So those financials look really good. Let's just take a look at the balance sheet. 1.5 billion of cash equivalents, and plenty of AR. So 2.9 of current asset. They have a little bit of property. They don't have any short-term debt. So again, 2.8, 2.9 of current assets, 900 million of current liabilities. Pretty strong position. They don't have any long-term debt. So 928 million of total liabilities versus 2.9 billion of current assets. Very, very strong balance sheet. Very solid and anti-fragile. Yeah, see, they have hardly any debt. 22 million of debt, and they've slowly been paying it down. Even the book value, $12 a share versus, so we're 4 times book value. I think we were 12 times book value on DoorDash. I'm not crapping on DoorDash. I think it's a very appropriate comparison. So that's pretty interesting, right? Let's take a look at these growth metrics here. Revenue growth year over year, 11.34%. Expected to be close to double digits in the go forward. EBITDA growth expanding. So there's some operating leverage there, and pretty good looking operating cash flow growth. Not really sure why we aren't populating these metrics here. But again, if we take a look, I think that because we've just, yeah, we're in the third quarter of the first year. We have a year over year number because again, we just recently went public. We see here pretty strong upward trajectory, both in the backward looking era and forward in terms of earnings estimates. They did have a slight miss last quarter. If we take a look at the, take a look at this. So this is the first quarter shareholder letter. Another thing about DoorDash is maybe I couldn't find it, but I didn't see this type of document on their website. What's up with that, DoorDash? Come on. Make it easy for me. So in the first quarter, they grew orders by 14% year over year to 83.2 million and drove GTV, which is gross transaction value, up 10% year over year to 9.1 million. See, here's another thing. I'm getting sidetracked here, but here's another thing I really like about these businesses. They are somewhat inflation protected because they're, as the marketplace, they're making a percentage. They're making a percentage of the volume of the transaction, right? So it's kind of like a Visa or a MasterCard. If grocery store inflation is 10% for an equivalent item, then assuming that the volume is constant for the following year and for a particular consumer, then there's the exact same volume, then the revenue of Instacart is 10% higher. Now, of course, that's oversimplified, and that doesn't happen in a vacuum because inflationary pressure does hurt demand, right? But I like the inherent inflation protection of these business models because you're scraping a percentage of the volume. So that's a really, really powerful. Those are really, really powerful economics that I really like. So they're keen on that, and that's why they track the gross transaction volume. So gross transaction volume up 10% year over year to 9.1 billion, and then delivering a net income of 106 million, adjusted EBITDA of 244 million. Pretty good. So here's how I got onto Instacart. So I'd actually never used Instacart in my life up until a few weeks ago. The reason for that is because while I have been using DoorDash for several years, I've always just gone to the grocery store to get my orders. Well, lately I've been busier with my work. I've been busier with what I've been doing, and so I've also been trying to be more efficient with our household grocery spend and buying more of it in bulk. I've been a huge Costco guy for a while. Well, on the Costco app, they have this same day delivery uh, service now, and it's powered by Instacart, right? So you can buy things from Costco and they'll be delivered for in 2 days. But if you want something same day, like sometimes I do with groceries, you can utilize Instacart through the Costco app. And with a Costco membership like we have, we're able to get a discount on the Instacart Plus. The Instacart Plus allows you to get a discount on the transaction fees of each individual order. So it's $79 a year with the discount. So you pay six something bucks a month to get lower fees every time you order, and that more than pays for yourself if you're utilizing it as much as I am. And even though we live pretty close to the Costco here, it is so busy. It's such a there's so much brain damage associated with going to the Costco. So I feel like by utilizing this service, I get really about 2 hours of my life back. And not everything's about optimizing time, but I get about 2 hours of my life back that I can spend hanging out with my family, doing deep work, expanding my capabilities. Right, and the amount of money that it costs to actually fulfill that order is much less than what those 2 hours are worth for me. So those are really good economics for me personally. Now, obviously, it does cost money to utilize these services, but that's how I got onto this Instacart thing. Is they've got this pretty much a partnership with Costco as the same day delivery marketplace in the Costco app, and I'm utilizing the Costco app to buy as much as possible. But that got me hooked onto this Instacart Plus thing, and now I'm utilizing that for just about any sort of grocery spend. Because I don't know about you, but when my family goes to the grocery store, physically we end up spending more money than we would otherwise because we see this and we see that and we see. But because you can utilize these services, you can basically change the supply chain of your household to be kind of this like lean, just in time supply chain model, which I really like because it allows inventory to be more actively managed. It's a lot easier to actively manage inventory of your personal household items and groceries and whatnot when you can utilize this like on demand fulfillment service. So, the logistics nerds out there should appreciate Instacart Plus. I certainly do. And I love to invest in things that give me economics, like things that I feel like I'm getting value out of, that I'm saving money by spending money out of. I love to invest in those businesses, assuming that they're publicly traded. Um, so there's a lot in here about some of the growth initiatives, business updates for consumers, launch Smart Shop. New technology makes it easier for customers to discover new options. So these are just kind of, I won't go too deep into these, but there's some expanded capabilities of the platform. They have an Instacart business platform, which is interesting. The Costco Business Center, Canada, they added a few retailers. So they've basically expanding their ad business. The ad business, tons of potential there with a company like Instacart, right? They have the platform. There's consumers with dollars looking to buy things. It's a great place to run ads. Strong possibilities there. And then this gives you an idea of some of the ad placement there. You can give it some parameters now about what your preferences are when it comes to items, and then they're utilizing AI to suggest more items to you. Whether that actually translates into growth, you hear these really strong numbers year over year growth in terms of revenue, or excuse me, that's just orders, 83 million of orders. The transaction volume up double digits, revenue up close to double digits. You see here, their transaction revenue is a percentage of gross transaction volume, 7% of each order. You see how much operating leverage there is in that, right? If orders going up and their transaction percentage amount staying the same, there's growth. If orders go up and they slightly increase their revenue take or their percentage take, that's pretty good, right? There's operating leverage there. So again, the model that they have is incredibly, incredibly strong, and is just a really, really strong and very strong investable. There's a strong investment case there to be made, that I think is really, really interesting. And then they're giving some strong guidance there. And I want to DoorDash has been the standout performer between the two, but the stock has performed very, very strongly over the last year. Both stocks have crushed the S&P, both on a year to date and over the last year. Over the last month, the stock has outperformed the market, albeit it does again. DoorDash, I think, has stronger risk-adjusted returns. But now we're zooming in a little bit too much for it to be material. One thing that I talked about in this video here about DoorDash, again, I'm not clowning on DoorDash, but we looked at the valuation. So it's clear that DoorDash has reached an escape velocity, both in terms of their business and in terms of investor sentiment. There's a lot of very bullish sentiment over the stock, which I've enjoyed a lot of because I've bought shares of it, and they've done very well. However, we see here that the valuation is very demanding right now. Well, the valuation of Instacart is significantly more palatable. We see here that the DoorDash, on a gap basis, both forward and trailing, the price earnings is absurd, right? Triple digits, whereas our price earnings here much, much more reasonable. 32 times, 28 times. I see no issue with paying close, hovering around a 30 times earnings for a company like this that is really in an early stage of growth, has compounder like economics in an early stage of its development, and is profitable, and has very, very strong profitability numbers. Again, we looked at the profitability of these two stocks, and there's very strong operating leverage and profitability with DoorDash. They have those low single digit margins, which honestly is probably more appropriate for a marketplace. The fact that Instacart is able to get away with such higher margins really is saying something. They are the leading grocery marketplace in North America, whereas, of course, DoorDash, facing competition from Uber Eats, though, does have the top market share. But you see here very strong margins. So honestly, I think Seeking Alpha has given this a D plus. I'm a little bit more excited about the valuation than that. I think that this is a very palatable valuation. I think here, Mr. Gary Alexander, he labeled growth at a reasonable price. That's exactly what I would indicate that current valuation is. I think it's a growth at a reasonable price. There's tons of growth stocks that have inferior economics to this, or more nebulous business models in the marketplace today that are trading at nosebleed valuations. So that's a valuation I can get down with. if we, zoom into our technical analysis aspect here, let's take a look at that. We've been in an uptrend for pretty much all of company history here. Stock just got slaughtered. I presume that that's Liberation Day. That's just stock did fine on Liberation Day. It had already sold off pretty bad before that. But the stock's been in this pretty bullish uptrend the whole time. It's remained within that, and I think that's totally palatable. I mean that channel basically, you know, the runway's all the way up, edging up to 60, and our downside is, down to 45 ish, maybe a little bit lower than that. Again, assuming the resistance and support there. Just a really clean looking chart there. Obviously, looks like the stock has been a little bit more volatile the last year than it was before. I shouldn't say great, but just a very unoffensive and very benign looking chart. Um, there's no red flags here, and the absence of red flags, along with the palatable valuation, I'm gonna have to grade this one a buy. I really like, borderline even a strong buy. In my main portfolio, I don't invest in things that don't pay dividends. It's really the only rule, and that's because it's the central liquidity pool to my everything I'm doing with investing, which includes real estate. But in a long duration tax advantage account like an IRA or something, a company like this, perfect, especially given the fact that I'm utilizing their services heavily, seeing a ton of value in utilizing their services. Therefore, I love to become a shareholder of a company that I enjoy like that. I think it makes a ton of sense. If I'm going to be a patron of the company, then I should reap some of the rewards of patronizing that company. Yes, I am one of those people that believes you should invest in companies that you see strong value in, that you yourself utilize. So that is the thesis there, in terms of the companies. Very, very strong economics of the marketplace, strong growth, very, very well managed, conservatively managed balance sheet with ample liquidity, and no dilution on a net basis. In fact, the share count's been going down, double digit earnings per share growth, um, at a very, very palatable valuation. There's a lot to like about the company. In terms of the risks, I totally forgot that that's what I talk about. Are the risks. In terms of the risks, it's going to be exposed to, it's a discretionary. Well, no, it says it's a staples. This one is a discretionary. It's not going to give you, at least I wouldn't assume that it would have defensive trading characteristics. While it has, performed very well, I would not expect it to perform well in a recessionary scenario. I have a special place in my heart and brain for those types of stocks. This is not one of them. Risk as well is that they face disputes with the labor. The labor aspect of their business becomes more complicated. That's always a risk. I don't think that that's very material. It's a more volatile. Any growth stock is going to be more volatile than other stocks. But yeah, I think there's a lot to like, and I don't see a chart risk here. I don't see a immediate risk in terms of where the stock price is now. If anything, I see it right in the pocket, and everything looks fairly bullish. So, of course, this is not a recommendation to buy or sell a security. This is not financial advice, and I am not a registered financial advisor. However, there's a lot to like about this, and I certainly do. So that's what I'm doing. I'm stamping it with a buy, and that'll conclude our video. Hopefully, you've found this interesting. Leave me a comment. Let me know how I'm doing. Also, want to mention that my viewers get $30 off of a Seeking Alpha subscription. I'll put that link in the description. So please check that out. Obviously, I use Seeking Alpha for a lot of my analysis that I do. It's love the tool. I utilize it very, very heavily. I also I write articles about these stocks on the Seeking Alpha. I write articles like this. So if you want to check out my analysis, which is a little bit more succinct and visually striking with charts, everything, uh, then be sure to follow me on Seeking Alpha. But anyways, that will conclude the video for today. Hopefully you found this interesting. I've certainly had a good time talking about it. Let me know how I'm doing. I love to interact. Thank you to my subscribers and thank you for watching. And I hope to talk with you soon. All right, until next time, have a good rest of your day. Goodbye.